Just over a decade ago, a financial crisis brought the global economy to the brink of collapse.
Today, stock markets across the world tumbled, imploded, continued to collapse like deflated dirigibles.
Not in generations has Wall Street absorbed the number of body blows it took today.
The American financial system is rocked to its foundation.
Louise, it's a mess.
I remember watching the apocalyptic news coverage, hearing the financial jargon, and while I realised this was an important historic event, I couldn't understand what was happening or why. And I couldn't know, then, how much that crisis would change the world. I couldn't know, then, that I'd end up making a YouTube video about it. But to understand the crash, we first need to understand the financial sector. So before we get to the apocalyptic subject matter of the video, we need to understand banks, their recent history, and how they work. Chapter 1. Money Magic. Imagine there's a place with one bank. And now imagine that, after delivering Han Solo to Jabba the Hutt, Boba Fett deposits his £100 reward at this bank. Boba goes off on more adventures and trusts the bank to look after his money and pay it some interest. The bank keeps some of that money in reserve, say 10%, and lends the rest out, creating debt.
What do you mean they blew up the Death Star?
Let's say they lend it to Emperor Palpatine, who uses the money to pay someone to design the second Death Star. The designer deposits the £90 into his account at the bank. The bank keeps its 10% reserve of that £90 and lends the rest out, creating more debt, which then gets spent and ends up as another deposit. Through the magic of lending, money deposited at a bank creates more money in the economy. Part of the magic is that the money is in all of those accounts at once, even though the extra deposits only exist because Boba's deposit was lent out. As far as the depositors are concerned, they all have that money in the bank, and the bank hopes that its reserves cover any of them making withdrawals. The upper limit of how much money can be created this way depends on how much the bank keeps in reserves. In this example, 10% reserves means that £900 worth of loans can be created from Boba's initial £100 deposit. The bank hopes that its borrowers will repay, and if some of them don't, the interest on the other loans will more than cover it. Credit scores are one of the ways that help banks determine if you are likely to pay back your debt. The banking system is built on belief. The depositors believe their money is safe with the bank and can be withdrawn whenever. Banks believe the borrowers will repay. This belief is where we get the word credit from. Credit comes from the Latin credo, meaning I believe, from which we also get the word creed. The system holds up fine so long as too many depositors don't want their money at the same time, and most of the borrowers repay. Now, this scenario is of course a big oversimplification. Boba's bounty for Han Solo was 224,190 Imperial credits, not 100 British pounds. And in reality, there are multiple banks. So when a loan is spent, it may end up as a deposit at a different bank. And when a deposit is withdrawn, it may simply be moved to another bank. And most money exists as numbers in a computer, not as physical cash. So, banks are money machines. They make money using other people's money. But they are also debt machines. They make debt by getting into debt. When a customer deposits money in a bank, they are lending that money to the bank, under the condition that it can be repaid, withdrawn, at any time. Because banks make money by lending, they want to keep as little money as possible in reserves. So their reserves running low is a real possibility. If that happens, the bank can borrow money from another bank to meet its obligations. Or it could borrow from the country's central bank, such as the Bank of England in the UK or the Federal Reserve in the US. A central bank is like a bank for banks. It's where banks deposit their money, their reserves. Central banks, like other banks, pay interest on their deposits. This interest rate is very important because it is how much money a bank can make without making any risky loans. Therefore, the interest on any loans must be higher than the central bank interest rate. Central bankers adjust the interest rate to influence the economy and inflation. When it's lower, people and businesses are more willing to borrow. The economy grows as people spend and businesses expand. The stock and housing markets rise, but so does overall inflation. There's more money about, so it loses value. When it's higher, there's less lending and spending. Inflation slows, but so does the wider economy, the stock market, and house prices. People with variable rate loans will find it harder to pay them back. So, a bank can borrow from other banks. And if a bank wants to lend more than it can with its deposits, it can borrow money wholesale from other banks to then make lots of smaller loans with. As well as lending, a bank could use the money to buy stuff that it thinks will increase in value, usually financial assets such as shares, derivatives, and bonds, which are collectively called securities. Shares mean you own part of a company, derivatives are like bets on how the price of something will change, and bonds are debts, which the bondholder receives the repayments for. Bonds get a rating, AAA to D, depending on how likely the debt is to be repaid. Government bonds are usually the highest rated and seen as super safe, because governments can, as a last resort, print more money to pay off their debts. Governments borrow so they can spend more money than they receive in taxes. Safe securities in high demand with a consistent price are easy to trade. They have high liquidity. Liquidity is a measure of how easily something can be exchanged for something else, how easily it travels through the global economy, changing owners. Money is the most liquid thing because you can exchange it for almost anything. Compared to money, it is far harder to exchange a Star Wars Power of the Force Boba Fett action figure. It has low liquidity. Safe securities with high liquidity are seen as cash equivalents. They are secure capital that banks can hold as part of their reserves instead of regular cash. Traditionally, banks that took deposits and issued loans were called retail banks, while those that traded in securities were called investment banks, and they didn't have customer deposits, so were extra reliant on wholesale borrowing. The difference between them has blurred a lot in recent decades. More on that later. Chapter 2. Imperial Dollars. In 1944, at Bretton Woods in New Hampshire, representatives of the Allied nations held a meeting that would shape the post-war world. Their goal was to agree on a way to stabilise world currencies and trade after the war's end, to prevent repeats of the economic conditions that had brought about the Great Depression and the rise of fascism. They decided on a system of fixed, pegged, exchange rates for the world's currencies. The American dollar would be pegged to gold and would become the world's reserve currency, while all other currencies would be pegged to the dollar. National governments would work to maintain these exchange rates through various policies such as capital controls, which limited how much money could leave the country. This system made global trade easier, contributing to the rise of large multinational corporations and the growth of industry in developing countries. It also meant that most international transactions were carried out in dollars, so there was high demand for dollars outside of America. These international dollars became known as euro dollars, because they were mainly held in Europe, and mainly in London. Britain was in a bad way after the war. There were years of rationing and rebuilding, money was short, and the empire was crumbling. Britain's financial sector, nicknamed the City, because it's based in the City of London, had ruled the financial world when Britannia had ruled the waves. And it wasn't going to give up that dominion easily. The globalised dollar was an opportunity that couldn't be missed. British banks could attract dollar deposits by offering international depositors a higher interest rate than American banks. And they could lend dollars to international businesses at lower interest rates than the Americans. The City also had a secret weapon, the distant remnants of the Empire. Britain's overseas territories and crown dependencies. They are owned by Britain but are not part of Britain, and in the aftermath of the war they were dependent on Britain for financial aid, which successive cash-strapped governments were not happy about. Becoming a tax haven was one of the few ways that small islands with minimal resources could become financially independent. So, successive British governments either actively encouraged or quietly allowed overseas territories and crown dependencies to become tax havens, where wealthy individuals and corporations could hide their money in secret to avoid paying taxes in their home countries.
As the imperial basis of its strength disappeared, the city survived by transforming itself into an offshore island, servicing the business created by the industrial and commercial growth of much more dynamic partners.
And so, through the magic of lending, Euro-dollar loans created more dollars in the global economy. And since they weren't in America, these dollars weren't subject to America's capital controls. They could flow freely throughout the world, being deposited and lent, hiding in tax havens, multiplying like a rampant virus. By the 70s, the combination of Eurodollar lending and American war spending had made the gold peg impossible to maintain. On 15th of August 1971, President Nixon announced that the dollar would no longer be pegged to gold, an event which became known as the Nixon Shock. Nixon Chew! Use Nixon Shock!
Suspend the convertibility of the dollar into gold.
With the dollar's gold peg gone, the Bretton Woods system broke down, and the world's currencies floated on a sea of belief. Chapter 3. The City and the Street. The collapse of Bretton Woods caused many currencies to lose value, leading to higher inflation. Everything got more expensive. Inflation got even worse when the price of oil rose suddenly, twice. Firstly, due to Arab countries refusing to trade with Israel's allies in response to the Yom Kippur War, and secondly, due to the Iranian Revolution. The price of oil is super important in the global economy. It affects energy, transportation, and production costs. So when the price of oil increases, it pushes up the price of loads of other things. This hit industries in the global north hard, especially since they were now facing increased competition from countries whose industries had grown rapidly under Bretton Woods. In Britain and America, the 70s was a decade of high inflation, rising unemployment, economic stagnation, and industrial strife. Voters wanted change, and in Britain, that change came in the form of Margaret Thatcher.
For more than a decade, the ranks of the unemployed have swollen in the wake of inflation. Whether we like it or not, things are changing. They're changing in technology. They're changing on the map. Faraway countries scarcely heard of 10 years ago now overtake us in our traditional industries.
And in America, that change came in the form of Ronald Reagan.
For those who've abandoned hope, we'll restore hope and we'll welcome them into a great national crusade to make America great again.
They shared similar beliefs and policies, which were inspired by the work of economists such as Milton Friedman and Friedrich Hayek, Chilean dictator Augusto Pinochet, and the British classical liberals whose ideas had been dominant until the Great Depression. Everything would be better if businesses were, as much as possible, left to pursue profit.
Greed never fails to motivate.
The government's job was to suppress trade unions and to shrink itself by binning regulations, spending less, taxing less, and transferring state assets to private owners. These policies collectively became known variously as
the Anglo-Saxon model, the Washington Consensus,
and
neoliberalism,
depending on who you were talking to. Shortly after taking office, Thatcher and Reagan abolished capital controls, meaning money could flow freely in and out of their countries. Thatcher believed that Britain's future lay with a post-industrial economy based on services, such as finance. And that future would start with a bang!
I move to immediately deregulate the banks.
In 1986, the Thatcher government binned most of the financial sector's regulations, an event which became known as Big Bang. The differences between retail banks, investment banks, and building societies were blurred. Skyscrapers shot up across the city to host the growing financial workforce. Trading at the London Stock Exchange became computerized. Transactions could be completed in seconds, not minutes. The banks could lend more freely than ever before, and were encouraged to boost home ownership, get businesses growing, and get people spending. While the London-based financial sector boomed, Britain's other industries were encouraged to die. Industrial areas went through massive decline, inequality shot up, and the economic divide between the north and south got a lot starker. The banks got bigger and bigger, and the smaller banks were swallowed up. A few big banks increasingly dominated the financial sector, and the financial sector increasingly dominated the British economy, meaning the banks got closer to politics and more influence over policy. Finance was Britain's thing. If it was doing well, Britain was doing well. And if it went down, it would take the entire country with it.
Foreshadowing.
To ensure the safety of the Republic, we must deregulate the banks.
Rather than with a big bang, American banking regulations, which had been imposed during the Great Depression, were picked apart across the Reagan, Bush, Clinton, and Bush II administrations. Wall Street's banks boomed as a result, and gained greater political and economic influence. Wall Street and London became the twin poles of global finance, through which the wealth of the world flowed. There was a
transatlantic deregulatory feedback loop
between them, pushing down banking regulations in both countries as they vied for dominance of the global market for financial services.
The world is changing. Who now has the strength to stand against
London
and
Wall Street?
Shortly after taking power in 1997, Tony Blair's new Labour government set about streamlining Britain's financial regulations even further by consolidating 9 specialist regulators into one entity, the Financial Services Authority, and weakening the Bank of England's regulatory powers. The response across the Atlantic was, of course, further deregulation of America's banks. Many of the regulations that were kept only applied to banks with customer deposits, so investment banks, hedge funds, money market funds, and other financial institutions with no deposits were even more free to do as they pleased. These extra deregulated financial institutions became known as shadow banks. The success of Britain and America encouraged other countries to go in a more
neoliberal
direction, especially after the fall of the Soviet Union. You might be wondering why so many politicians thought financial deregulation was such a good idea. Wasn't this dangerous? Wouldn't the banks get up to all sorts of dodgy stuff? The dominant economic doctrine of the time was the efficient market hypothesis. The idea was that financial markets are really complicated, and banks are really complicated, and are full of the cleverest and most rational people in the world doing really clever risk management with really clever computer programs. And because these really clever bankers were rational people working in their own self-interest, they would regulate themselves better than any government could. It wasn't in the bankers' interest to do anything that threatened the future of the bank where they worked, or the future of the entire global economy. So they wouldn't. This belief gave bankers monstrous self-confidence. They were too smart for regulation. What regulations that were left, they would do their best to get around them. So, regulations were being scrapped, the leftover regulations were being dodged, and the regulators were staffed by people who didn't think regulation was necessary. The approach of the Financial Services Authority was principles-based. Banks were encouraged to agree to broad principles for better business, and, if they did, they were rewarded with a regulatory dividend, meaning lighter scrutiny over their activities. Gordon Brown boasted that FSA regulation was
not just a light touch, but a limited touch.
In the aftermath of the crash, the head of the FSA said,
A principles-based approach does not work with individuals who have no principles.
Chapter 4. Mortgage Magic. In the 1930s, during the Great Depression, the American government passed a series of reforms known as the New Deal. This included stricter banking regulation, meant to prevent anything like the 1929 crash from happening ever again, but also a promise to extend home ownership to more Americans. They needed a way to encourage banks to lend more mortgages while also keeping them strictly regulated. So they created a new entity, the Federal National Mortgage Association, which became known as
Fannie Mae.
It was the beginning of the secondary mortgage market. Fannie's job was to buy mortgage debt from banks, so the banks were then able to make more loans. But she would only buy mortgages that conformed to a strict standard, loans from people with good credit history and a low chance of default. Prime loans. For 30 years, Fannie was the only thing buying mortgages from the banks, until she had a daughter, Ginnie Mae, and gained a nemesis, Freddie Mac. Ginnie Mae had the bright idea of packaging together a bunch of mortgages and selling the bundle to investors as a security.
Mortgage-backed security, MBS.
Whoever owned the security would receive the income from the repayments. And then in the 80s, the GSEs worked with investment banks to create a new breed of financial asset.
Collateralized mortgage obligation, CMO.
These were made by bundling together loads of mortgages, then splitting the bundle into tranches with different risk levels and repayment amounts, which could be sold separately to different investors. The highest level, lowest risk tranches paid the least amount, but the money from the mortgage repayments went to them first, and then flowed down to the lower level, higher risk tranches. If some of the mortgages defaulted, money would still reach the higher level tranches, but it might run out before reaching all of the lower levels. Since the money went to the top levels first, the chances that a top level CMO wouldn't pay out were extremely low. It would take a massive collective default to make the top level tranches not pay out.
Foreshadowing.
These securities were bonds, so needed to have a credit rating. The top-level tranches got AAA ratings, just like US government debt, because the chance of them failing was so incredibly low. Fannie, Freddie and Ginnie made a lot of money selling these securities, so other banks got involved. They could make the securities themselves, with whatever mortgages they wanted, even mortgages from people with bad credit history, and a high chance of default. Subprime loans. And then some clever people created a new breed of financial asset.
Collateralized debt obligation, CDO.
These were made by bundling together a bunch of middle and lower ranking CMOs, and then splitting the bundle into tranches with different risk levels and repayment amounts, which could be sold separately to investors. The money from the CMOs would go to the high levels first, then flow down to the lower levels, who might lose out if some of the CMOs didn't pay up. It was extremely unlikely that lots of different CMOs wouldn't pay up, so the chances that a top-level CDO wouldn't pay out were extremely low. And then some clever people created a new breed of financial asset.
CDO squared.
These were made by bundling together a bunch of middle and lower ranking CDOs, and then splitting the bundle into tranches with different risk levels and repayment amounts, which could be sold separately to different investors. The money from the CDOs would go to the higher levels first, and then flow down to the lower levels, who might lose out if some of the CDOs didn't pay up. It was extremely unlikely that lots of different CDOs wouldn't pay up, so the chances that a top-level CDO squared wouldn't pay out were extremely low. It would take a massive collective default to make the top-level tranches not pay out. And then some clever people created a new breed of financial asset.
Credit default swap, CDS.
Essentially, this was an insurance agreement. The owner of the debt paid someone else a regular fee to take on the default risk. It was extremely unlikely that AAA-rated debt wouldn't pay out, so it was easy money from the insurer's point of view. Through financial magic, debt from people with poor credit history and a high chance of default could be turned into AAA-rated, ultra-safe securities. Why did these things nearly destroy the global economy? Chapter 5. Mortgage Madness. Thanks to Bretton Woods, American dollars had become the global reserve currency, with which most international transactions were carried out. This meant that there was a lot of dollars held by wealthy internationals and foreign governments who wanted to invest them in safe, AAA-rated dollar assets, such as American government debt, or mortgage-backed securities. AAA-rated mortgage securities therefore had high liquidity because there was so much demand for them. They were a safe investment, and the banks treated them as a cash equivalent. Thanks to deregulation, American banks were freer to borrow more money wholesale than ever before, and they could lend more mortgages than ever before, and they then turned these mortgages into securities. And because banks want to keep as little money as possible in their reserves, they used short-term wholesale borrowing to meet their daily obligations. With the end of capital controls, money could flow far more freely around the world. The financial system became incredibly globalized. The world's banks formed a huge web of interconnections. Since there was so much money to be made from selling these securities to investors, foreign banks set up in America to get in on the action. And these foreign banks were extra reliant on borrowing dollars wholesale because they didn't have any dollar deposits.
In the mid-1990s, banks like Britain's HSBC aggressively bought into the American mortgage market. By 2005, HSBC could boast of having serviced 450,000 mortgages to a total value of $70 billion.
The two main methods of wholesale borrowing,
repurchase agreements, repo,
and
asset-backed commercial paper, ABCP,
both require safe, highly liquid assets which the lender gets to keep if the borrower fails to repay. Banks were keen to borrow as much as possible, and while they were certainly allowed to borrow more freely than before, it wasn't enough. They knew what they were doing better than the regulators and the politicians, so they did their best to get round what regulations there were. Banks used tax havens to borrow more than they were allowed. They set up a shadow bank in a tax haven and sold it some securities. The shadow bank would then use these securities to borrow wholesale and use the money it borrowed to buy more securities from its parent bank, which it could then use to borrow even more. The parent bank owned the shadow bank, but because it was registered as a tax haven, its borrowing was kept secret from regulators. By the end of the 20th century, deregulated banks were excitedly getting themselves into lots of debt, lending mortgages, and creating securities to sell to a global market of investors who couldn't get enough of them. In the first year of the new millennium, excitement about the internet led to the stock value of many internet companies becoming overvalued and then crashing down. The dot-com crash. Stock market crashes put people off investing in stocks, so investors turn to less risky assets. The demand for safe securities increased. In the second year of the new millennium, the 9/11 terrorist attacks caused a stock market crash and significant damage to the American economy. Investor confidence in shares dropped even further. In response to both of these events, Alan Greenspan, America's central banker, cut the Federal Reserve interest rate to historic lows to help the economy recover. Flashback! When it's lower, people and businesses are more willing to borrow. The economy grows as people spend and businesses expand. The stock and housing markets rise. End of flashback. Banks lowered the interest rates on their loans to customers, so more Americans could afford mortgages, and American home ownership reached a record high. But Fannie and Freddie still dominated the secondary mortgage market until 2003 and would only accept prime loans. However, accounting irregularities were discovered, their activities were capped, and the market was left wide open for private banks, who were more than happy to use subprime loans. Since the loans were being converted into securities to sell on, the banks didn't care about how likely the borrower was to repay. They didn't do thorough credit checks, they just loaned the money, converted the loans to securities, and sold them on. People who couldn't really afford mortgages were getting them, encouraged by the banks who wanted more loans to turn into securities. They even lent what became known as
ninja loans.
Mortgages to people with no income, no job, or assets. As one former loan officer has said,
you had no incentive whatsoever to be concerned about the quality of the loan, whether it was suitable for the borrower or whether the loan performed. In fact, you were in a way encouraged not to worry about those macro issues.
From 2004, fully half of the subprime mortgages being fed into the system had incomplete or zero documentation, and 30% were interest-only loans to people who had no prospect of basic repayment. By 2006, 70% of new mortgages were subprime or other unconventional loans destined for securitization.
And yet, the securities made from these loans were considered ultra-safe. They were given AAA credit ratings. To get their securities rated, the bank took them to one of the ratings agencies and paid a fee to get them assessed. But if the bank wasn't happy with the rating, it might take its securities and its fee to a rival agency. The ratings agencies were therefore incentivized to keep the banks, their customers, happy by giving them the ratings they wanted. They made a lot of money rating mortgage securities, giving the banks the high ratings they wanted on top-level tranches. The ratings agency staff were aware that this was going to end badly.
Let's hope we're all wealthy and retired by the time this house of cards falters. Smiley face.
It's difficult to comprehend the numbers involved in this mortgage madness.
Overall, mortgage indebtedness in the United States climbed from $5.3 trillion in 2001 to $10.2 trillion in 2007. The mortgage debt of American households rose almost as much in the 6 years from 2001 to 2007 as it had over the course of the country's more than 200-year history. That's hardly much of a history, if you ask me.
When the crisis hit, most bankers, politicians, and economists claimed to have been blindsided by it. This was a totally unexpected event which no one could have foreseen. But it wasn't just the ratings agency staff that knew this was going to blow up. The first chapter of the US government's Financial Crisis Inquiry Report describes many people warning of the calamity to come, but being shut down or ignored. Journalists, lawyers, loan officers, even some bankers warned that what was happening was dangerous and unsustainable. Many of the bankers who tried to warn their superiors were told to stop being so negative, and were then promptly sacked. Others decided to bet against other banks and the US economy itself, forming the Big Short position, which became the subject of the book by Michael Lewis and its excellent film adaptation. Chapter 6. Crunch Time. The rise in American home ownership and house prices led to a massive rise in consumer spending. When house prices are rising, people who own homes are more likely to be spendthrift because their house is passively making them wealthier. By 2007, about 70% of American households own their own home. And according to the Congressional Budget Office,
the rise in real home prices since mid-1997 added between $130 billion and $460 billion per year to consumer spending.
In 2004, after the American economy had recovered from the dot-com crash and 9/11, the Federal Reserve started to raise its interest rate, incrementally over 17 tiny steps. Therefore, the interest rate on variable rate mortgages went up, so monthly repayments increased and people across the country found it harder to repay. At the same time, the price of oil was going up, pushing up the price of other things with it and making it harder for people to afford their mortgage repayments. But even without these factors, the repayments would have stopped coming eventually. Loads of mortgages were bad loans to people who would never repay. Across the country, people stopped making mortgage repayments and started losing their homes. Across the world, mortgage securities stopped paying up. Investors realised the securities had been wrongly rated and wrongly priced, and now no one knew how much they were worth. All mortgage securities plummeted in value, no one wanted them, and having lost their value and their liquidity, they could no longer be used to borrow wholesale. The banks, reliant on wholesale borrowing for their day-to-day funding, were in a bit of a pickle. They were desperately trying to avoid collapse, selling whatever assets they could for quick money, causing asset prices to plummet.
Today, stock markets across the world tumbled, imploded, continued to collapse like deflated dirigibles.
They became reluctant to lend to anyone, except at extremely high interest rates. This was the
credit crunch. It looks like credit, but it's a breakfast cereal.
With fewer personal loans and credit cards being issued, consumer spending decreased. And since the demand for mortgage securities had collapsed, American banks became especially unwilling to lend mortgages. This meant fewer people buying houses, so house prices plummeted. About a quarter of American households ended up in negative equity, meaning the house was worth less than the mortgage debt. When house prices fall, homeowners become more frugal because they are passively losing wealth. Consumer spending decreases. Larger monthly repayments also meant that Americans had less to spend elsewhere each month. And, obviously, all the people who had lost their homes to foreclosure weren't spending as much on fun anymore. Hundreds of businesses collapsed, throwing millions into unemployment. Businesses that survived downsized and abandoned plans for expansion. If they had still wanted to expand, the extraordinarily high interest on new loans put them off.
Loans to big businesses in the United States fell from $702 billion in the second quarter of 2007 to as little as $150 billion in the fourth quarter of 2008.
But this wasn't just an American crisis. Finance and trade had been globalized. Around the world, banks seized up, house prices and consumer spending plummeted, businesses collapsed, people lost their jobs. All this caused tax revenues to collapse, so governments borrowed more to make up for the shortfall. Unemployed people have less money to spend than those with jobs, so with each job loss, consumer spending took another hit, increasing the strain on businesses. Unemployed people are also more likely to not make their mortgage repayments and become homeless. As the crisis progressed, mortgage securities became even more worthless, because prime borrowers who would have made their repayments became unemployed and no longer could. The collapse in house buying also meant the banks couldn't sell the houses they repossessed, so they couldn't get the money back that way either. As people became unemployed, lost their homes, struggled with debt, mental health problems were exacerbated, and the number of suicides increased. And since the banks were desperate for money, they became a bit more relaxed about where large deposits came from. During the crisis, billions of dollars of drug profits were laundered and legitimized by desperate banks. With mortgage securities, shares, and real estate plummeting in value, investors looked elsewhere to make money. They turned to derivatives based on food prices, which caused the price of many foodstuffs to rise rapidly, leading to famines and food riots across the world. For more on that, you should watch Dumpster Flower's excellent video on the 2008 world food crisis, which is linked below. It was a relentless global economic apocalypse.
What made the collapse of 2008 so severe was its extraordinary global synchronization. Of the 104 countries for which the World Trade Organization collects data, every single one experienced a fall in both imports and exports between the second half of 2008 and the first half of 2009. Every country and every type of traded goods, without exception, experienced a decline. Not since records began had there been such a massive synchronized recession. Tens of millions of people were thrown into unemployment. In the United States, the monthly rate of job losses topped 800,000. Precisely how many people lost their jobs across the global economy depends on our guess as to joblessness among China's giant migrant workforce. But reasonable estimates range between 27 million and something closer to 40 million unemployed worldwide.
Chapter 7. Banking Reloaded. When the banks started to struggle, they suddenly became far more positive towards the idea of government intervention in their affairs. Former Chancellor Alistair Darling recalls that at the April 2007 meeting of G7 finance ministers,
banker after banker told me that there was a looming problem and that they would be looking to the government to resolve it. In short, it was a one-way deal. When times are good, get off our backs. When they're bad, you have to help us.
The entire banking clan is on the verge of collapse.
Collapse?
the banks knew that if they were allowed to die, they would take our entire global economic system with them, and they knew that governments would not allow that to happen. Over 3 decades, banks had absorbed each other and grown so big that they were vital nodes in the global economy. They were too big to fail. They had also become entangled in a complicated web of international connections thanks to financial globalization. They were too interconnected to fail.
The overwhelming majority of private credit creation is done by a tight-knit corporate oligarchy. At a global level, 20 to 30 banks matter. Allowing for nationally significant banks, the number worldwide is perhaps 100 financial firms, though it is hardly a secret that we inhabit a world dominated by business oligopolies. During the crisis and its aftermath, this reality and its implications for the priorities of government stood nakedly exposed. The ferocity of the financial crisis in 2008 was met with a mobilisation of state action without precedent in the history of capitalism. Never before outside wartime had states intervened on such a scale and with such speed.
It can be a source of national pride that, as Britain kick-started the revolution in banking deregulation, it was a British bank that was the first to be rescued. Northern Rock collapsed on 14th September 2007. Savers queued up to collect their money, draining the bank of its reserves. It was the first bank run in Britain since 1866. Parliament rushed through legislation allowing the government to take control of failing banks by compulsory share purchase, spending £25 million to stabilise the bank. At the time, it was the largest sum any government anywhere in the world had given to a private company. Across the Atlantic, investment bank Bear Stearns was saved by the Federal Reserve buying $30 billion worth of mortgage securities and lending it $12.9 billion. Then Fannie Mae and Freddie Mac needed rescue, at a cost of around $190 billion. And then there was Lehman, which the government failed to save. The fall of Lehman meant 25,000 people lost their jobs on the same day, and it sent a wave of panic through the financial system. Stock prices collapsed as traders anticipated more banks going bust. Wholesale lending seized up even more. If Lehman had been allowed to die, might the rest of the banks? The next day, American insurance company AIG was on the verge of collapse, and it was far too interconnected to fail. It owed billions to banks and investors throughout the world who had insured their mortgage securities with credit default swaps. The Fed first loaned AIG $85 billion, but this money went straight to the banks that owed CDS payouts. Later on, AIG got another $37 billion, then another $40 billion. And then, the same month they announced a $61.7 billion loss, the largest loss in corporate history, the top executives of AIG's financial products division, the division that had been responsible for the credit default swaps that had nearly destroyed the company, received $165 million in bonus pay.
Let the hate flow through you.
As more American banks failed, the tactic of responding to each bank collapse individually was getting tiresome and inefficient. A comprehensive plan was needed to deal with the entire banking sector, and the Treasury came up with a program to buy the bank's dodgy mortgage securities, the Troubled Asset Relief Program, TARP.
Under our proposal, the federal government would put up to $700 billion taxpayer dollars on the line to purchase troubled assets that are clogging the financial system.
Across the Atlantic, Chancellor Darling was getting daily reports on the state of the banks, which were given code names.
My private secretary would give me a note telling me how Jupiter was faring, that Lapwing was failing, or that Badger was in a bad way. It got frustrating, trying to remember which was which.
The Royal Bank of Scotland, RBS, the biggest bank in the world, was about to collapse. And it was up to Britain to show the world how to save the banks.
There was an enormous amount of work to be done, but we could not delay. Every nook and cranny of the Treasury was filled with huddles of my officials, bankers, lawyers, advisors, fighting and arguing over every last detail. Gathered around desks, sitting in corners on the floor in open plan offices. I hadn't eaten since the night before, so fed up with the traditional Treasury crisis diet of pizza, we sent out for takeaway. We agreed we should order it from Gandhi's in Kennington. Soon, the table at the end of the private office was piled high with chapatis and foil containers filled with curries. It was later called the Night of the Baltic Bailout.
Extraordinary times call for the bold and far-reaching solutions that the Treasury has announced today.
The Baltic Bailout plan had 3 parts.
1. Recapitalisation.
The banks needed money, and they had to have a plan to get it. If they couldn't come up with a plan, then the government would take control by buying newly issued shares. Only RBS and Lloyds took the government money, £20 billion each. The other banks found money elsewhere. For example, Barclays got their money from slave state Qatar, and are currently under investigation for fraud. While HSBC did loads of money laundering, and were fined $1.9 billion in 2012 after a US investigation.
2. Credit guarantees.
The banks needed to borrow, but no one was trusting them to pay their debts. For a fee, the government would guarantee wholesale loans to banks. If the bank failed to pay, the government would cover it. Over £500 billion worth of wholesale loans were guaranteed by this scheme, but none of the banks ever failed to repay.
3. Asset swaps.
The banks needed to borrow, and they needed safe assets in order to do that. Through the Bank of England's special liquidity scheme, banks could, for a fee, temporarily swap useless mortgage securities for UK government bonds, and they could then use these bonds to borrow wholesale. The Balti plan became the model which other governments based their bailout plans on, though Britain had to top it up with a second bailout a few months later. In Europe, national governments pledged billions of euros in assistance for their failing banks. But for various political reasons, a joint European bailout was vetoed by Germany. Across the Eurozone, bailouts were patchy and inconsistent, leaving the area vulnerable to another financial shock. Back in the US, Treasury Secretary Hank Paulson announced some Balti-inspired changes to TARP. $125 billion would now be used to buy newly issued shares from America's 9 largest banks. The Federal Reserve ramped up its activities to a whole new level, creating a range of programs with long names and annoyingly similar acronyms to swap or buy securities and to lend on a scale never before seen. Foreign banks who had joined the American mortgage market were desperate for dollars, and they couldn't get dollars from their own central banks. The Fed swapped $2 trillion worth of US Treasury bonds for mortgage securities. Over half of this went to non-American banks. And it lent $10 trillion to central banks around the world, so they had dollars to lend. Since 1944, international trade and finance had become increasingly dominated by the US dollar. And as the crisis hit the global economy, the empire of the dollar was saved by the Federal Reserve becoming not just America's central bank, but the world's. One European central banker remarked.
In a way, we became the 13th Federal Reserve District.
The total collapse of the global economy was prevented, so the bankers could get their bonuses. Large bonuses were paid to bankers across the world, as their firms collapsed around them and were rescued by governments. Britain's RBS paid £1.3 billion in bonus pay, after announcing a £3.6 billion loss and receiving the government bailout. Wall Street firms paid $18.4 billion in bonuses after announcing tens of billions of dollars of losses. Merrill Lynch alone paid almost $5 billion in bonuses after announcing a $21.5 billion loss. This did not improve public opinion of the banks.
I can feel your anger.
You might have thought that lots of bankers would have gone to prison for being complicit in the near collapse of the global economy. Some lost their jobs. Most famously, Fred Goodwin, former CEO of RBS, lost his job and his knighthood, and was punished with early retirement on a £340,000 a year pension. Johnny Cameron, former head of RBS investment banking, was banned from having a full-time job in the city. Around the world, 47 bankers were imprisoned for their involvement in the crash, including one in America, but none in Britain.
Look at the last 10 years. The wars, the financial meltdown. Who profited? Who came out on top? You thought you were protecting Queen and country, but it's all about the bankers and their bonuses.
Chapter 8. Aftermath. Throughout this video, I've had to skip and simplify a lot. But the skipping and simplifying is most extreme here. The crash and the bailouts cast a long shadow over the following decade. In Europe, the patchy bailouts and ballooning deficits left the Eurozone vulnerable to another crisis. The shared currency meant that member nations didn't have the power to, as a last resort, create new money to pay off their debts. What if one or more of the Euro governments couldn't pay their debts, and couldn't be trusted to borrow more? The sovereign debt crisis plunged Europe into another recession. As this was happening, two economists published a paper that put the fear of debt into politicians. Growth in a time of debt argued that as a country's government debt increased above a certain threshold, its economy was harmed, its growth slowed. The crash had caused government borrowing to skyrocket everywhere as tax revenues collapsed, and all that debt was now a ticking bomb, threatening every country's economic future. In 2010, the world turned to austerity. Government spending had to be cut, debts paid off. The paper wasn't peer-reviewed and was later heavily criticised for methodological flaws, but by then the politicians had committed and it would have been really embarrassing to backtrack. And in Britain, our politicians had committed very thoroughly to austerity.
We've got to remove this dark cloud of the deficit over our economy, and it makes sense to make a start on that now.
We've taken difficult decisions to halve the deficit.
We're reducing the deficit so we deal with our debts, safeguard our economy for the long term.
So thoroughly, in fact, that the leaders of other countries had tried to warn David Cameron that he was taking the austerity thing too far, and was actively damaging the British economy, and by association the entire global economy. What this meant for Britain was a decade where, while the rescued banks boomed, the wider economy stagnated, including here in Nottingham. Here, as elsewhere, people struggled on lower wages, fell into poverty and homelessness. Here, as elsewhere, businesses shrank, failed, or abandoned their plans for expansion.
I moved back to Nottingham in 2010, having grown up here. I was shocked to see the extent of the problems, especially in retail. You could just see that the whole economy had shrunk.
In April 2007, Westfield, then owners of the Broadmarsh shopping centre, had announced a £500 million plan to thoroughly redevelop the centre and the surrounding area. But then, in November 2011, just before work was about to begin, Westfield issued a statement.
We have taken the view to withdraw from Nottingham. Areas outside Greater London have been heavily impacted by the global financial crisis and other austerity measures.
And so, Westfield sold Broadmarsh to Into, and its redevelopment was delayed for another decade. If you'd like to learn more, I recommend these books which I used while researching this video. Thanks for watching.